Today, I want to share a number with you that stopped me in my tracks when I read it. So, McKinsey just released one of the largest surveys of American economic sentiment ever conducted. There were over 30,000 adults across all 50 states, encompassing every age group, every income level, every race, and ethnicity. And they asked people a simple question: what's standing in your way from getting ahead? Now, 60% of Americans, that's 6 in 10, cited the rising cost of living as one of their top three barriers. Not job loss, not education, not discrimination. It was all cost of living. And it just wasn't lower income households. In fact, people making over $150,000 a year cited it nearly at the same rate as people making under $50,000. Now, you might be listening to this as a real estate investor and thinking, okay, macroeconomic issue, not really my problem. But I want to make the case today is that this data is directly related and relevant to how we think about Class B multifamily investing. Because the people in these survey results, they're the people in our buildings. They're our residents, right? And understanding how they experience money, housing, community, and stability is not a soft, feel-good topic. It's underwriting input. It shapes renewals, collections, occupancy, and ultimately returns. Now, I'm John Makarewicz, co-founder of Ferris Capital Partners and co-host of the Multifamily Investor Playbook. So today I'm going to be walking you through this McKinsey report through the lens of a multifamily investor, pulling out the data points that actually matter for how we operate and how we think about the people we serve. So let's get into it. So as I said, this was a massive survey. There was actually 30,119 people surveyed across all 50 states. It took place between April 1st and April 13th of 2026. So interestingly enough, this was sort of right around the time kind of prior to the war in Iran, where gas prices have now also doubled. So as we go through this data, you'll see transportation concern being a little bit less. I suspect if this study was done, sort of in like July or August, where we sit today of 2026, we'd see that be a little bit higher of a concern. But the bottom line is they even did follow-up interviews. They did some sort of like meetups where they interviewed in focus groups and really kind of got deeper into these topics. And so why is this information relevant to multifamily investors? So often we talk about renter demand in terms of these macro drivers, household formation, migration patterns, home ownership affordability. So for example, when we talk about affordability, there are some markets where they look great on paper for multifamily investing, but the cost of the average home is actually equivalent in terms of a monthly mortgage payment to the rent we're targeting. So those are generally markets we avoid, right? So we're looking at these things. Are people moving to the area? Are people getting married and having kids and sort of, forming these households? But, affordability is something we're obviously looking at. So are the incomes high enough to support the rent, but is it still more attractive to rent than to own based on the rents we're targeting, right? So this survey is really about adding sort of a lived experience layer to this data. And how do the people who make up that demand actually think about their financial situation, their housing costs, and their ability to get ahead? And so for Class B workforce housing operators, this data isn't academic. It sort of directly informs how we think about pricing, retention, amenities, and the relationship between operations and returns. So diving in a little bit more here, bottom line, right? 60% of Americans cited rising cost of living as a top three barrier to getting ahead. And this was consistent across all income levels, geographies, ages, and racial and ethnic groups. Now, 39% described themselves as either getting by, but financially vulnerable, or struggling to meet basic needs. So that's nearly 4 in 10 Americans. So Gallup in April 2026 had this stat: a record 55% of Americans say their financial situation is getting worse, which is up from 47% in 2024. So these rising costs we're all experiencing at the grocery store and at the gas station, and really insurance across the board, right, is something everybody in America and Canada is feeling. Now, CNN did a poll as well. 76% of Americans identified the cost of living as their biggest economic concern, which was up 58% from April 2025. Now, the income surprise, this was sort of interesting, right? This idea that respondents in this poll earning over $150,000 were actually slightly more likely than those earning under $50,000 to cite rising costs as a top barrier, right? It was 59% for those making over 150 to 57% for those making under 50. So not a massive gap there, but very intriguing to see that, right? Because at the end of the day, affordability stresses everybody out, right? And so when that stress is moving up the income ladder and no longer confined to those lowest income earning households, it means the middle class and the upper middle class are feeling the pinch as well, right? So what's the implication of that, right? The renter universe for Class B housing includes people who might have previously been ownership track buyers, right? Those on their way to buy a home, but are now priced out or cost constrained in ways that keep them in rental housing longer. So in this study, McKinsey had this to say. So across places, age groups, income levels, and races and ethnicity, affordability consistently emerges as the most frequent cited barrier to getting ahead. So what are Americans actually worried about when it comes to pricing and the cost of living, right? So grocery and food was number one, cited by 90% of those polled, so as their top concern. So it's the most frequently named category. Now, housing was 57% cited as the top concern, so the second most common. Transportation, 50%, but as I touched on, based on the timing of this, with gas prices going up in the past few months, I suspect if this poll was done today, we'd also see gas perhaps even pass by housing. And I'll tell you why. There's sort of a nuance that play here, and it's really a factor of psychology, right? So why do you think food gets cited more than housing, even though when you look at things like housing and insurance costs and childcare, the cost of those services have actually risen more sharply than groceries have? But it's the frequency, right? It's like you go to the grocery store a couple of times a week, maybe once a week, maybe 2-3 times a week. And so every time you're scanning your card or putting that money down, you're feeling that pain. So it's sort of a frequency bias, if you will. So even though housing and insurance costs have risen more sharply than groceries in terms of inflation, that daily sort of weekly engagement at the grocery store is likely why that has surfaced as the top concern. So bottom line, as an operator, right, when residents are managing top budgets, around things like groceries, gas, utilities, and rent, it's all, taken together, right? So bottom line is at our properties, we have started to see an increase in delinquency. In other words, when residents are unable to pay their rent, and that has led to evictions. And so it's never a place we want to be in. We're still screening our residents with all the same screening criteria, but people are feeling that pinch. And so a year ago, perhaps their income well supported their lifestyle, but now because of these rising prices, they're feeling the pinch. And all it takes is maybe one of the two residents losing their job or losing some hours at work to put them behind. So, it's something we're diligently addressing, and we're looking at our screening criteria to see how we can mitigate and manage that going forward. But due to these rising costs, we will likely continue to see a little bit of a higher elevation or level of delinquency. So, moving very quickly when we see these issues and processing so we can get that resident out and bring in a paying resident is certainly something we're focused on. But look, it's never a fun or a good thing to have to evict a tenant. So it's something that is just an unfortunate reality of the market we're in right now. Now, the homeownership barrier, I mentioned this earlier, right? Rising cost of the average cost of a home. So the median age of a first-time home buyer is now 40. Now, on previous podcasts, you might have remembered we mentioned that stat. In fact, last year it was 39, but on average, it's like 27. So the past few years to go from 27, I think it's been like 5 years where it was sort of averaging 27, 28 for years and years and years. So for the past, really 5 years back, going back years, that average age was 27. Now all of a sudden we're seeing today's average first-time home buyer, 40 years old. The national median home price was 5 times the median household income in 2024. So bottom line, ownership has effectively priced out a large share of the workforce. And those monthly home payments are up approximately 86% since 2018. Now, big driving factor there, not only the cost of the home itself, but back in 2018, we had very low interest rates. Now interest rates are much higher, 2 to 3 times higher, depending on what time of you're looking at and comparing them against. And so that means the monthly payment is up 86% since 2018, which is massive. I mean, that's just massive, right? So a lot of folks just aren't able to get past that barrier. So what's the practical effect of all this? So households that would historically have transitioned out of renting into ownership in their late 20s or 30s are staying in the rental market through their 30s and into their 40s. Hence, that average age of that first-time home buyer going up from that, late 20s to now 40 years old. So, going back to the McKinsey report, they had this to say: the costs of housing, childcare, healthcare, and education have risen faster than many households' incomes, leaving many Americans feeling like they are diverging economic paths. Now, there's sort of like three life stages when it comes to how we think about different age cohorts, right? So those young adults, 18 to 24, they're ambitious, financially fragile, but also optimistic, right? So young adults are the most career-oriented group. Nearly 8 in 10 identify advancing their career or earning more income as a top aspiration in the next 1 to 2 years. They face the toughest job market in decades for new graduates, right? So raising questions about AI's impact on entry-level work and compounding cost pressures with thin financial cushions. So 34% of young adults cite mental health as a top barrier to progress, more than twice the rate of older respondents. So they're feeling anxiety, perhaps even some depression about what they're seeing in the job market as they leave college and try to get into their first career. So what's the surprise? Despite these pressures, young adults actually are showing more optimism, I should say, than older cohorts on nearly every measure. So, maybe it's just a little bit of young, they're ambitious, right? They're more likely to believe that their financial situation will improve in the next 5 years and more likely to feel that their lives have momentum. So young adult renters are often stretched financially to be in our buildings, right? They're optimistic and resilient, but they're also one unexpected expense from a financial crisis. So very important that in general, we run very consistent screening. Doesn't matter if you're 18 or 78, right? You're going to have the same screening requirements, but it's just something you have to think about, right? So that goes back to why we like to see 3 times income in terms of the rent to income ratio. Then we get into stage 2. These are generally like your parents, right? The range roughly 30 to 50s, stretched but determined. So parents are balancing competing financial demand. They have childcare, housing, debt service, and they're trying to build assets for their during their prime earning years, trying to build out that retirement, right? So basically, childcare is unaffordable for nearly 2/3 of American families, including essentially all lower income families. So if you can't afford childcare, somebody has to stay home and take care of the kids, right? Therefore, there's less income coming into that household. So it's sort of a vicious cycle, right? In fact, a lot of lower income or middle income people even find, say, for example, if the husband or wife who's at home with the kids ends up getting a job, that the cost of childcare effectively just offsets whatever income they're making, right? So perhaps even that additional income bumps them into another tax bracket. So for many folks, it's just not even worth getting into the job market. One thing that's interesting to note actually is our job market is softening right now in the US, but the unemployment rate has remained the same. And even in the most recent month, data went down 0.1%. But what's missing in the headline is that 1 million people have just simply opted out of the workforce in the past few months. They've just decided it's not even worth looking for a job. And so I don't love how we talk about unemployment in this country. I think when people are giving up and just saying, you know what, I wanted a job, but it's just too hard. There's not great opportunities out there. I'm just going to stay at home. That should be measured. So it looks like, oh, wow, unemployment rate is low, but people are just opting out of the financial system altogether. So, what's the operator implication of this kind of parent cohort, right? So the family household in a 2 or 3 bedroom Class B unit is often our most stable, sort of longest tenured renter. They're not moving. They want to stay in the same school districts. They have routines, social networks that anchor them. Maybe it's team sports, bowling league for the parents or whatever. So, we love that cohort, right? We actually talk about those hometown heroes, the nurses, the nurses, firemen, police officers, teachers, very, very much the types of residents we like in our buildings. But once again, we welcome all as long as they meet our screening criteria. And then you got stage 3, which is your pre-retirement adults, right? And so they're prioritizing security above all. There is some sobering retirement data out there. Median retirement savings balance for workers who have saving at all is just $40,000. So most people self-report needing 1.5 million in savings to retire comfortably. The majority of people have less than $40,000 as they approach retirement. So that is, pretty scary, right? That's not going to be enough to maintain, right? And Social Security will come in certainly, but there's going to be a lot of pressure there. So 1 in 5 adults over 50 have no retirement savings at all. That's data from the AARP. More than 60% worry their money will not last throughout retirement. So, operator implication: older renter cohort is often your most financially cautious and risk averse. So, rent increases need to be justified and predictable. Surprise changes or maintenance lapses hit them harder emotionally and financially than they hit those younger renters. So, for us, we're all about making sure work orders happen in a timely fashion. It's one of our biggest pressure points we put on the groups that manage our buildings from day to day. So we definitely are trying to make sure all of our residents have that experience, but understanding there are those that are going to feel that stress and that pressure a little bit more. So, one of the things that we think a lot about is kind of the community connection, right? So one of the interesting things that came out of this survey is that when respondents feel strongly connected to their community, they're more than twice as likely to feel they have a say in their lives, more than 3 times as likely to feel in control of their future, and nearly 4 times as likely to feel their lives have momentum. Only 1/3 of respondents report feeling very connected to their neighborhood or community, and even fewer people say people like them have a meaningful say in decisions affecting their local area. So community connection is huge, and it's one of the things we really focus on at Ferris Capital Partners and at our Ferris Residences properties is trying to build that sense of community. Strong community managers who know their residents by name, know their kids, know their interests, community events, walking the property on a daily basis just with the opportunity to, number one, inspect the grounds, make sure the property's looking good, but most importantly, to actually have moments of connection with residents. Maybe they're walking to their car, come back from work, just an opportunity to connect. And so by having these community events, bringing the residents together, trying to build that sense of community is absolutely the goal. So basically, what this means and how we operate, right? So this is why we like these Class B assets. When you've got a lot of people that are feeling financial pressure, they want something that's nice, but feels like there's value, right? And so when a Class A brand new, say mid-rise or high-rise is built, depending on what market you're in, but I'll sort of speak to Charleston. In the suburban Charleston market, you might be paying $2,200 for a 1-bedroom brand new Class A apartment, where a renovated unit that we're offering at, say, Goose Creek or Monk's Corner might be closer to 15.5 or 16.50, right? And so that feels much better. It's renovated. It's got all the bells and whistles. It's nice and it's fresh and it's clean. But it does not have that heavier price tag of that Class A. So making sure we're doing all the right things, building those communities, making sure work orders are handled effectively, making sure the grounds are clear and clean and free of debris, focusing on markets like in the Sun Belt where there is heavy in-migration. So Florida, Georgia, South Carolina, there's no rent control, landlord-friendly regulatory environments. They look after the residents, but in a way that's balanced where the landlords also have rights. So, bottom line is this is a little bit of a caveat, I suppose, but, keeping in mind that 39% of Americans are financially fragile. So that means some late payments, right? Occasional skipped months and residents who need some patience. So our operations need to be built in that reality. And it's something we're absolutely seeing today. It really snuck up in a sense late last year, early this year, where the elevation started. And now, once again, with rising gas prices added into the mix, we're feeling a little bit more. So we're actually not actively targeting any new deals at this moment as we wait to see how things play out over the coming months. But you better believe when we start looking again, very conservative underwriting, clinical pricing discipline, and really focusing on a proactive, exceptional resident experience. So if you've sort of been intrigued by what we've talked about here and would like to learn more, go to fulloutinvesting.com. That's fulloutinvesting.com. You can learn a little bit more about what we're up to here at Ferris Capital Partners. We have a sample deal, a video that walks you through our 10-step process for identifying and acquiring these apartment investments and an opportunity to connect with us. Thank you so much for listening to the Multifamily Investor Playbook. We love and believe in you. If you think somebody would benefit from hearing this content, please share with them and like and subscribe and keep dreaming and investing big.